Okay, very good evening, everyone. Warm welcome and thank you everyone for joining us for today's webinar. It's now 7 p.m., so we will kickstart the webinar proper. My name is Haiti. I'm from the sales team at Saxo Markets and also the host for tonight's webinar. And I'm happy to inform you that the content today is brought to you by Saxo in collaboration with CSOP Asset Management. And we are very honored to have Bruce with us today. He is a portfolio manager from CSOP. And as you all know, today's topic is focusing on the opportunities present in Southeast Asia and also especially in tech. So hopefully by the end of webinar today, it can give everyone some trading ideas and also inspiration for the upcoming months. And if you have any questions along the way regarding Saxo platform or the content being shared, feel free to post them in the chat box at any time. And we will be addressing all your questions at the end of the webinar during the Q&A session. And before we begin, this is a disclaimer that the content shared today is for your general knowledge and it does not constitute any financial advice. So please only trade or invest after you have read and understood the risk. And our webinar will total take about 45 minutes, and this will be the agenda for today's session. I will start off with a quick Saxo Trader Go platform walkthrough, followed by Bruce's presentation on the SEA opportunities present in the Southeast Asia market. And we'll have some time for Q&A after that, and followed by the closing remarks and release of the promo code. Do stay with us until the end because we'll be releasing the promo code, which you can use to win some commission credits and also door gifts from us, especially for our clients. Okay, let's start with the Saxo Trader Go platform. So for those of you who don't have an account with us, you can simply just go to our website, Saxo, home.saxo, to open an account with us. If you are an existing client, you can just key in the URL, saxotrader.com, or you can access our platform from our homepage. So you just have to click login. Give me 1 second. Okay, when you log in to our platform, this is how our trading platform looks like. Saxo offers different platform for different type of investor, and our platform is available both on the desktop and also mobile app, which you can easily download from the App Store. So this makes it very convenient for our clients to trade on the go. So this is how the main screen layout looks like, divided to 3 main sections with 3 main headers at the top. And since today's webinar includes sharing on tech and also ETF, so if you are interested to diversify your investments, do take a look at Saxo Research tab at the top. And under the themes, we have different themes, baskets, and we also have, especially for the technology, you can find it under the Research tab later on. And in line with today's presentation on ETFs offered by CSOP, you can also create a dedicated screener on the trading page. So under the watch list, you can create a dedicated watch list for the ETFs that are offered by CSOP. Or you can just go to the screener function, filter out the ETFs, choose ETF under the filter, and you can choose the issuer as CSOP. Just have to key in. And it will show you all the ETFs that are currently being offered by CSOP. Under the watch list, you can also create a new watch list. Just click new. And just search for the instrument. And you can add them directly to the watch list to monitor. Okay, so with that, I believe I've given you a quick understanding of how it works on our Saxo Trader Go platform. And it gives me a great pleasure to welcome Bruce from CSOP to share with us on today's topic on opportunities in Southeast Asia market as well as for technology. So I will now hand over the time to our partner speaker, Bruce.
Thanks, Haiti. Good evening, everyone. Thanks for attending today's webinar. The topic for today is towards a sea of opportunity, the CSOP Edge Southeast Asia Plus Tech Index ETF. Here, SEA or C refers to the great opportunities and also an abbreviation of Southeast Asia. And additionally, plus here means India. And my presentation will divide into three parts. First, I'll talk about why Southeast Asia plus India. And second, I'll talk about why technology stocks. And then I will discuss why investors should consider using CSOP ETF, tracking the SGX IH index to access the region's technology investment opportunities. And at the end, we'll have a Q&A session. And first, we think Southeast Asia plus India has the potential to create the next economic miracle. And as global investors and corporations look for growth, and everyone is wondering where is the next China? And some says ASEAN could be the supply chain of the whole world, so the new China could be ASEAN. Well, some says India may have the fastest growth rate in the coming years, as the nation is expected to have the greatest transformation as compared to other countries in the world. Therefore, we seek for opportunities in both ASEAN and India. You can also say it's AI, ASEAN and India, due to the continuing capital inflows into the regions. And thanks to these inflows, we have been witnessing the startup booms in Southeast Asia since around 10 years ago. Back to 2014, there were only two names, Grab and VNG. VNG is the Vietnamese company focusing on online games. But in 2021, there were already 46 startups, and some of them already became the unicorns in the region. And when we conduct our client pitch, and we will always ask why don't we directly invest in those China or US technology giants? Why should we invest in those Southeast Asian, Indian tech names? And our argument point here is that even the global tech giants, they also eye on the region's unicorns, investing in the firms such as Grab, Imtech, and also the Gojek. So those giants may not only act as investors, but also want to replicate their success in the region through their models. And the venture capital and private equity investment also grew rapidly, mainly dominated by the technology investments in India and in SEA. Additionally, the global corporations like Apple and Samsung are relocating their supply chain to the region. For example, Apple is to shake up their international sales operations to make India its own region, and its next MacBook production center is likely in Thailand. And Samsung is building US dollar 1.3 billion equivalent EV battery plant in Malaysia. And we believe the supply chain shift typically starts from the easiest part, such as the middle end or low end manufacturing, and then gradually transfer to the high end manufacturing. And following those overseas players settle down, they prone to cultivate the local and equipment suppliers. And these moves are echoed by the foreign direct investment inflows. For example, in 2021, the FDI in Southeast Asia rose by more than 40% to US dollar 174 billion, the pre-pandemic record. And ASEAN remained a top recipient of the FDI in the emerging markets and continued to be a growth engine. And such strong inflows pushed the FDI stock in the region up to over US dollar 3 trillion, and also an increase of over 70% from 2015. So it is not surprising that the regional market leaders are emerging. Now the region has its own version of Alibaba, such as SEA Ltd, and its own version of Uber, such as Grab, and its own version of, particularly the Indo-Malaysia version of Netflix, such as Imtech. And we believe the long-term thesis is the local giants can finally become their global peers, competitors. For example, Malaysia has been a central hub for semiconductors since 1990s, focusing on the packing and also the testing. But after multiple years of working experience in the global firms, Malaysia's local mechanicians and also engineers, they join the supply chain established by themselves and conduct the semiconductor equipment business, and also the OSAT business. And in the second session, I'll talk about why we focus on technology names in the region. We believe the opportunities mainly come from two angles. First is the industrial chain relocation, reflected in robust exports and FDI. And the second is the internet adoption driven by the demand for services such as e-commerce. And both drivers are on the back of a favorable demographics, which provide sufficient and cost-efficient labor forces and macro growth potential with the rising income levels. And as for the industrial train relocation, the population of SEA plus India is over 2 billion, or around one-fourth of the world total population. The region's working age population is also over 1.4 billion, which is already comparable to China's total population. But the region's median age is just around 29, 80 years below the China's median age at around 38. But the minimum wage of the region is just about half of China's. So whether from a age perspective or from a cost perspective, the region's labor resources are quite competitive. And if we combine these with the for example, the supply, the rising labor costs elsewhere, and also combine this with the supply chain concerns and even the geopolitical tensions elsewhere, these actually form some of the key reasons that international businesses further diversify their manufacturing into the region. And the move is also welcomed by the region's countries with policy support such as tax incentives and ease of the incorporation process. It is also worth noting that as the region's countries have different levels of development, they could leverage their unique comparative advantages. For example, Singapore could focus more on the high-end manufacturing, and India and Indonesia have potential to expand their supply chains. And in the meantime, the Vietnam can still leverage its cost advantage. And we believe the current global industrial relocation to SEA and India represents the fifth industrial transfer over the past 170 years, followed by the first four rounds from UK to the US, then to Japan, and to the four Asian tigers and to China. Now it's ASEAN and India's turn, and it has been reflected in the surge in exports led by the high-tech sectors from the region in recent years, as shown here. And the transfer also has some near-term benefits. For example, the local producers' pricing and gross margin could be more sustainable if large clients wish the local suppliers, to expand their capacity, these global firms may subsidize their capital expenditure. And the recent example is that Apple already granted suppliers in expanding the capacity for the SiP packaging in SEA. And in terms of the internet adoption, the combined GDP of SEA plus India already surpassed Japan since 6 years ago, making the region the world's third largest economy next to the US and China. And the macro growth speed in India is also anticipated to outpace China, with its GDP more than doubling from US dollar 3.4 trillion to US dollar 8.5 trillion to become the world's third largest economy itself by 2027. And the rising income and middle class, it's a result of the fast economic expansion. The urbanization rate among the SEA plus India region, except Singapore, still has plenty of room to improve, and the GDP per capita across ASEAN will grow by 4% per annum, and ASEAN's middle class is exploding to the point that it will include nearly 70% of the region's total population by 2030, contributing 140 million new consumers, or representing one-sixth of the world's new consumer class. So maybe in the future in Singapore, you will see more and more crazy rich Southeast Asian, crazy rich South Asians spending their money. And another trend here is the huge and fast-growing internet users, particularly due to the region's large young population, which provides a potential client base for development of digital economies in India, as well as the SEA leading economies such as Singapore, Malaysia, Thailand, Vietnam, as well as Indonesia. And the region's internet sector, according to a survey research conducted by the Temasek and Bain Company, are also expected to register a double-digit growth in the next 3 years. So on the back of this, these would generate a great demand for the internet services, leading to the internet industry blooming in the region, such as e-commerce, online travel, online media, ride-hailing, food delivery, as well as fintech. There's also a global IT demand being outsourced to India, Vietnam, and the Philippines. So that's also one of the key reasons we not only include Southeast Asia stocks, but also the Indian stocks. And taking Indian as an example, more than 500 companies in India are offering the outsourcing services to over 66 countries, and half of the global Fortune 500 firms are outsourcing their IT developments to India alone. And page 23 lists the top 10 holdings that our ETFs benchmark has as end of March this year. The index already conduct the rebalancing right before our product listing, but the top 10 holdings are pretty more or less the same. There are already some familiar names there, such as SEA Ltd. Uh, the company has a dominant market share and cost, and there is cost optimization is in progress. And as compared to SEA Limited's competitors, SEA still has strong logistics and pricing power, as well as some offering edges. And regarding Grab, it also has a dominant market share in the region, and its current cost rationalization will also help them better positioned if we see increased tourism, economic activities, and we have seen some renewed demand for food delivery in the region. And in addition to these two names, we also have the Indian tech giants such as Infosys, as well as the Wipro Limited. And we also include some high-end manufacturing firms such as Jardine Cycle, as well as the Astra International, as both firms are benefiting from the EV cycles because they provide some relevant EV power management as well as EV distribution. And we also have some stocks like the local version of the online apps, such as the Indians version of the Expedia, such as Make My Trip, and also again Indo-Malay's version of the Netflix, such as the Imtech. So briefly speaking, our stocks linked to internet adoption or the consumption related has a slightly the weightings has slightly more than 50%, and the stock linked to the great industrial chain relocation is also nearly 50%, so almost half in our investment universe. And in the last section, I will highlight why investors should access the region's technology names using the CSOP IH Southeast Asia Plus Tech Index. And page 25, it's a snapshot of our CSOP ETF. Now we have two trading counters on Singapore Exchange, the SQU, which is in US dollar, and SQQ is in SGD. And both counters can be fungible, which means the investor can buy USD dollar counter and sell it in SGD, and vice versa, buy SGD and sell in USD. And in order to track the investment universe as closely as possible, our ETF will conduct the passive management with the representative sampling strategy and subject to each underlying stock's trading availability. And through our ETF, investors can access the market in two ways. First, investors can trade the ETF starting from 1 unit only. Now the 1 unit cost is just roughly 0.95 SGD, SGX, without touching the underlying stock trading. And secondly, investors can create or redeem ETF shares like a mutual fund in primary market, but the starting threshold will be slightly higher, which is around 200 to 200,000. And we leveraging our dedicated index portfolio management and trading team. We target to create a diversified SEA plus India tech portfolio with the efficient trading. And through a quarterly rebalancing, our ETF will help our investors capture the investment themes by overweighting the stocks with the larger free float weights and sufficient liquidity, and including the rising stars immediately, which manage to meet the index inclusion criteria through our fast entry rule. And in terms of the benchmark we are using, as the name suggests, our ETF uses the IH Southeast Asia Plus Tech Index. The index actually issued by the Singapore Exchange itself, and the index aims to track the performance of the largest 30 technology companies domiciled in Southeast Asia and in India. And securities captured within this index include companies primarily in technology-related sectors, such as IT, software, and consulting, but we also include the EV manufacturing and electronic components, and also some high-end manufacturing, and even some retail names, which of which firms already investing a lot in technology-related sectors and has a revenue closely linked to the technology. And all the eligible securities should meet the certain revenue thresholds to the relevant technology sectors. Such, for example, for a single company, our technology-related revenue threshold should be at least 40%. But for conglomerates, including multiple entities, their tech-related revenue threshold is actually 50%. And on the top of that, the liquidity screening is also applied, such as the minimum 12% free float and 0.1% velocity thresholds to ensure the diversification, to ensure the investment universe not only includes the largest names, but also are liquid enough. To ensure the diversification, 10% single stock cap and 50% cap for Indian domiciled companies are in place to avoid the concentration in certain securities or in certain country. And the rebalancing frequency is quarterly in March, June, September, and December. And the newly listed security through IPO will be added to the index if its full market cap ranks within the top 10 of the existing constituents on its first trading day, in addition to meeting all the existing requirements. And as of March 2023, our benchmark already gained nearly 45% per annum over the past 3 years. Yeah, thanks to the technology boom right after this outbreak of the COVID-19, and its Sharpe ratio is over 1.6. And over the past 5 years, the index annualized return is more than 14%, with a Sharpe ratio exceeding 0.5. And over the same period, past 5 years, its performance is actually in line with Nasdaq 100 index and significantly outperformed the MSCI Emerging Market Equity Index over the period. And in terms of the underlying geographical breakdown, if we divide this by listing place of listing, currently we have Singapore, Malaysia, Indonesia, and Thailand local listed stocks, but we also have some US listed stocks such as Indian ADRs and Grab. So we include the US listed SEA and India related stocks is mainly because we want to make sure our stocks has enough liquidity for investors or for us to trade. And in terms of the underlying geographical revenue breakdown on the bottom right, the index is diversified in countries dominated by SEA and India. And as for the sector breakdown on the left-hand side, the index now emphasizes on the electronic components and the manufacturing, software, and as well as some retail names. So in summary, this Singapore-listed CSOP IH Southeast Asia Plus Technology ETF offers a unique investment opportunity and providing exposure to 30 leading technology firms in Southeast Asia and India, and covering the sectors like technology, electronic components, manufacturing, and retail, thereby capturing the potential of the emerging Asian markets. So I'll pause here and see if any questions.
Thank you, Bruce, for sharing your insights. Yeah, very interesting and informative, especially with the latest AI boom in the markets right now. And for the audience, if you guys have any questions regarding the content shared, please do send them in the chat box. But we do have a couple of questions for Bruce to address today. Yeah.
Sure.
So Bruce, one question, right? In your opinion, is it really a good time to enter C Tech right now?
Yeah, sure. If you look back the performance of the ASEAN or Indian tech names, they did experience a boom period, let's say right after the uh, outbreak of the COVID-19, because after that event, or they actually the global interest rate are quite supportive, and also people are increasingly rely on the technology technology. That's why we see a boom since then. And and moving to the, so that's why 2021 we actually experienced a surge in terms of the GMV, the so-called gross merchandise volume, and in 20 and in second half of 2021 and first half of 2022, it's more about the improvement of the profitability. But since the Fed has kickstart to in terms of its most aggressive hikes since over the past 40 years, we do see the tech names as well as other risk assets. They experiencing a relatively challenge period, and this also combined with a relatively slower growth after the year 2022. But the good news that the technology name has started to rebound starting from the beginning of the year, as we see some maybe perhaps we see a relatively less hawkish Fed, perhaps in the second half of the year. And now the underlying tech names focus more on the balance between the GMV growth and also their profitability. That's why we see some cost adjustment, or yeah, for by the largest name in our portfolios. So from at the current stage, I would say after the recent declines in May and also sometime in the second half of June, the current drawdown of the region's tech names is already negative 30%. And historically, we only see one time the drawdown is over negative 30%, which is negative 40% happened exactly during the outbreak of the COVID-19. So typically, the historical maximum drawdown is already negative 30%. So from now, we believe the market downturn or the downside, maybe the probability of the downside is much less than the probability of the market upside. In particular, given that if the macro growth manage to recover or manage to improve in the second half, and if the Fed can finally take a breather, and if the emerging market FX can stabilize, because most of these technology giants in the region, their revenue sources from the emerging markets in the region. If they can see a more stable fundamental growth and a more stable emerging market FX, we do believe it's a good time to enter the ASEAN tech or the Indian tech.
All right, yeah, got it. Thank you. And one more question from the audience is, they want to know if the ETF that you mentioned just now, Southeast Asia Tech ETF offered by CSOP, is there a dividend payout for that particular ETF?
Yeah, these ETFs is very quite interesting, because in Singapore, investors may see a lot of ETFs focusing on dividend, it's an equity ETF or whether they're asterisk ETF or it is a bond ETF. But this ETF, we designed this ETF, it's mainly for growth potential. So which means the underlying stocks are mainly include comprising of the growth stocks. So their dividend maybe not as attractive as those value stocks, but their growth potential can be much larger than those value stocks. So in order to use this ETF, the investors can either act as a long-term investors to enjoy the long-term capital appreciation of these ETF, or investor can also leverage their potential relatively large volatility of the ETF to timing the market. So from this perspective, the ETF will focus more on the potential capital gain instead of the dividend. So the ETF will not pay the dividend, and the dividend yield itself also not attractive because the underlying stocks, their average dividend yield is less than 2%. So instead of paying it out, we'd rather reinvest in this dividend received into the stocks to enjoy the future price gain.
Okay, yeah, thank you for the answer, Bruce. And the next question is, I believe just now you mentioned you showed us about the management fees for the ETF. So
Mm.
just a quick question, like how are these management fees decided for your ETF offerings?
Yeah. Actually, the management fee for the ETF for now is 0.99%, or you can say almost 1%.
Mm.
Someone may say, okay, why you charge such a high fee? But actually, if you put this fee, compare this fee to compare other emerging market equity ETF, the 1% management fee is quite fair. This is mainly because um, if investors directly trade those stocks, they need to open every single local account, and also subject to a potential high trading cost. But through our dedicated trading team, we first of all, we can help investors save their cost by already opening every underlying account. But more importantly, by leveraging our trading scale and trading network, we can save a lot of this trading cost because our counterparties can ensure very competitive commission, and sometimes even ensure a market on close price for us. So from this perspective, we can save a lot of trading costs or even hidden costs for investors as compared to their direct investment. So if investor using our ETF, and another reason is that since this ETF is designed to capture these long-term capital appreciation, actually the potential high volatility accompanied by the potential higher return, so will dominate the ETF's performance. So the management fee of 1% is actually a very small portion in the context.
Okay, understood. Yep, thank you. And last question is, I think just now you also briefly mentioned about the fast entry rule. So if you could elaborate a bit more on that, like how it works under your index methodologies.
Sure. Typically, an ETF will mainly invest in the stocks already listed on the exchange. So f- so investors may have concerns that, okay, well, if I invest in your ETF, I may miss the chances for some new the upstarts to first let's say firstly issued on the exchange, or miss those IPO opportunities. So to mitigate this problem, we tend to include those IPO stocks if we found their first day trading or the market cap already ranked in our ranking top 10 in our existing universe. So we'll target to include those names by the 10 days. 10 days may be also long, but we'll try to control this within 10 days framework to help investors to enjoy this, let's say, the first few days or first few weeks surge for those successful IPO stocks. So that's a new fast entry rule we included in our portfolio and benchmark. I think that's what we have been. This is a result that we have been discussing with the index issuer, SGX. Then we come up with this solution for investors.
All right, thanks for that. Okay, I think that was our last question. So thank you, Bruce, for addressing the questions and also for taking your time off to conduct this webinar. And also to our audience, a big thank you for joining us today. We hope that Bruce sharing is useful for your future investment ideas, especially in ETF, technology, Southeast Asia. Yeah. And also please head over to our platform, Saxo Trader Go, to look for these instruments related to Southeast Asian markets or technology to diversify your portfolios. And if you do not have a Saxo trading account yet, you can also easily open one. It takes about 10 minutes roughly to complete the application online through using SIMPass. And if you have any sale queries or feedback regarding today's webinar, do drop us an email at ps@saxomarkets.com. And this webinar is also recorded and will be uploaded on our website, platform, and social media channels within next 1 to 2 days. And you can also scan the QR code to access the webinar recording. It should be available after 3 working days. So I would like to end off today's webinar by releasing the promo code. So for our audience, Saxo clients, and also our potential clients, you can send the code CSOPX Saxo to our email, ps@saxomarkets.com. For the fastest first 10 people, we'll be giving away $20 commission credits that you can use for your trade, and also a door gift from Saxo. And that is all we have for this evening. Once again, thank you, Bruce, for your kind sharing today. And for the audience, if you have more questions related to CSOP ETF, management fees, anything, feel free to drop us an email and we will get back to you through email. And with that, thank you everyone for joining us tonight. Have a great week ahead. Thank you.